Good afternoon, Steve Yoler. How are you doing today, sir?
Doing well, Shawn. Thanks for having me. Appreciate it.
Oh, yeah. Thanks for joining us. And so, Steve, today you are with Lending with Purpose. These are conversations that we have with our clients and our friends, introduction to various forms of information and professionals like yourself, our resources that we use, Steve, that we look for, that we never knew existed or wanted to learn more about. That was a mouthful, right? That was a lot. But, welcome today. And so, I always search for some sort of a story, Steve, or did you know, or something like that. We're going to get into a bunch of did you knows today, I think. But I was thinking about before when you asked me how things were going, and we kind of were talking about numbers games and things like that, like in regards to activity and what we're doing. And so I personally think, the way things are, kind of going these days, that we need to focus on as much positive as possible because, Steve, you've been in the mortgage industry in various positions and such, but largely in originations. And it typically comes back around, right? Like things change.
Right.
And so I was thinking about just a quick story. A friend of mine this week sent me a picture, and it was a picture of her daughter, and she had like this wrap around her head, like a big bandage. And I looked at the picture even more, and I said, "Is that an ambulance?" And so she's like, "Yeah." She was messing around on the sofa. She fell off. She hit her head. Now she's got stitches, and she had to get a staple in her head, right? And so immediately I'm thinking like, all right, did she learn anything, from that experience? And so
Right.
I'm thinking she's gonna be like, well, yeah, she learned not to be jumping around and horse playing, right?
Okay.
So her response was, that she got to meet helpers up close and personal. She got to ask questions and things in the ambulance, right? She got to hear a 911 call. And she's like, yeah, lots of learning. But now she understands to, not to sit on the side of the sofa.
Right.
When she asked for her not to horse around anymore. So in that moment, I was like, wow, she took something, because I honestly was taking it to a negative aspect. Like, I don't know, maybe if my kid, I'd be like, well, I told you to stop horsing around. That's why you got a staple in your head. But, she took that whole negative situation and really turned it into a positive thing. And so I'm hoping if we can do something like that in this industry, we'll get through this as quickly as possible. Winning every day is important. And so today, everybody, we're going to be here to talk to you about some affordable mortgage options and really have a really candid conversation with Steve. Steve is, I consider Steve an expert. He's our account executive that we work with Plaza Home Mortgage. And he's always a go-to. Wealth of knowledge, has a ton of information. And so today we're going to get at it. But Steve, that's the best introduction I can do for you, I guess. There's a little bit more that I guess I probably could say, but you'll do a better job than I. So tell us who you are, what you do, and we'll get into our conversation.
Sure. Steve Yoler, account rep for Plaza Home Mortgage. Been in mortgages for a little over 20 years. Started off doing originating, then an AE, and then an LO, and then back to an AE. So I've kind of, I've been in your shoes, and now I kind of work with loan officers like yourself and other clients here in the area and around, just trying to help my partners grow their business. Whatever I can do to make you guys more successful, that's what brings me to work each day.
Awesome. And you had some exciting news that happened today. You said you got a text message in all caps. Is that right?
Yeah, that was from my son. That was yesterday. He made the basketball team. So I was very excited about that for sure.
Shout out to your son. Congratulations. So like, let's talk about like becoming an account executive. So you said you've been doing this for 20 years. Like, what's that been like, the progression from then versus where we are today?
Absolutely. So when I started as an AE, it was probably right around 2001, 2002. Market was booming, a lot of non-traditional products that don't exist anymore because it was prior to the crash. So really it was a race to, understand all the different product offerings that were out there. I mean, there was just so many different offerings. with non-traditional products that I spent an extensive amount of time just making sure I knew all the guidelines and all the different products, because to me, knowledge is power. And if you know where to slate your clients or what product's going to best suit, that's going to help you be successful. So that's really what I spent a lot of time doing when I was training as an AE, was studying guidelines and products. And then once I had that, then I was basically, armed and equipped and ready to help my clients. As far as what's changed, though, I mean, a lot has changed, obviously, in the last 20 years, right? I mean, you're talking about having 100% no-doc loans at one point prior to the crash versus, obviously now we document ability to repay. We want to make sure we put people in loans that they can afford. We're not doing things like that anymore. So while the landscape has changed, it's been all for the consumer. So, I mean, it's not like the changes are arbitrary. Obviously, the changes are necessary to bring stability to that market and really just evolving, as things change, because, you and I have been in this business for a while. As things change, being able to adapt, if what you were doing before isn't there or it's drying up, being able to add a new stream or a new avenue of business or a new product offering or a new client or a new relationship, just being able to continually kind of change and shift with the market and not be stagnant. I think I lost audio. Sorry. I lost you, Shawn.
Now, Steve.
There you go. You're back. You're back now. Okay.
All right, cool. I guess I'll get rid of this microphone and lost connection. So, Steve, how you started out as an LO, right?
Yes. Yes, I did.
That's what we just talked about. And like you transitioned into wholesale. What's the difference between, being a loan officer originating on a day-to-day basis, dealing directly with the consumer, working with referral sources and such, to working in the wholesale industry? Let's talk about that. Number one, and number two, the difference between retail and wholesale.
Sure. So the difference for me as, loan officer or account rep is really who my client is, right? So like your client is the ultimate borrower. You're maybe needing to, go at a slower pace because it's a first-time buyer, somebody that's not familiar with the terminology and the acronyms and the jargon that goes along with the mortgage industry. So it's a little bit more of a hand-holding, a little bit deeper, longer of a conversation to help the home buyer ultimately understand the process and what to expect next. Now, transitioning over to an AE, it's a little bit faster paced. You're dealing with mortgage professionals that tend to know the guidelines, products, et cetera. So the conversations are happening a little quicker. It's more high level, structuring products. So it moves a little faster paced just because the familiarity with the products and the guidelines and the mortgage professionals I'm working with, as far as like where to better suit them or where to put them in a product. It's not a lot of explaining why I feel like this is the right move. And then as far as the difference between retail and wholesale as a consumer, if they go to a retail shop and they, are that's their loan officer, that shop basically has the products that they have. That's it, right? So they're going to offer you what they have. It's all done in-house. And, maybe their product offerings in general aren't as extensive as a mortgage broker or a mortgage lender, because you get more flexibility when you can partner with, Plaza plus a multitude of different lenders, to where you have different product offerings and maybe a little bit wider net as far as what you can offer, with the relationships that you're supposed. That's not always the case, but the opportunity at least presents itself, with that, because you can just, add a new lender relationship as an independent mortgage broker.
All right, cool. So elephant in the room, right?
Yeah.
The biggest thing that we talk about these days are the fact that the market is shrinking, like our opportunities are shrinking, right? Mm-hmm. And a big piece of that that we're seeing is because the rising interest rates, right? Mm-hmm. I mean, the market's still great. People are still buying and selling houses, but based on what we're accustomed to seeing over the past, few years, nowhere near the level of activity. And it's actually probably over I was reading the last 20 years or so, the lowest form of activity that we've seen as well. But affordability seems to be something that is an issue or a problem, right? And so what everybody's scrambling to try to do is to help the consumer and help the homeowners really get into a situation that they can actually afford, right? And I personally think affordability is greater and better every day of the week over qualification, right? Just because you qualify doesn't mean necessarily that it's the right thing for you, right? Just because you qualify doesn't mean that you can afford it, because affordability is going to lend to us being able to have a sustainable home ownership, right? And so let's talk about, a few ways and a few products that we've seen out there, that you've seen out there, that are really helping with getting lower payments, with helping more people get into homes while we have this higher interest rate environment.
Sure. Well, the rise of the interest rate kind of has brought back that temporary buy down, which you've probably seen in the market, either the 2-1 buy down or the 1-0 buy down.
Hold tight.
Yeah, absolutely.
I cringe a lot of times when I hear the word buy down. Everybody is talking about buy downs. I've been in the industry, almost as long as you, not quite. I think it's going on 19 years for me. We talk about it. No one ever used the product much at all. It's being utilized quite a bit now from what I'm hearing and seeing, but everybody's talking about buy downs. Before you get into the difference in the 2-1 and well, actually not even that. Like, I think you were headed that direction.
Yeah.
Let's specifically talk about what that means to do a buy down.
Absolutely. Great question. Okay. So I'll start with a 2-1. So what it means, what this is it's a budgeting tool. So if you have a bar, we talked about affordability was a great lead into this buy down. Let's say you're working with a prospective home buyer. They talk to you today, you quote them out a mortgage payment, and maybe they get ratified in 1 month, 2 months, 3 months from now. It takes time, and then they get ratified, and now the rates have increased, and now their payment is more than what they were willing to swallow, and it's a little bit of a shock. They say, "Oh, Shawn, I didn't know my payment was going to be this. I thought it was only going to be that," because the rate moved on you, right? Well, what the buy down really does is it takes money that otherwise would have been applied towards your closing costs in the form of a seller concession. Usually is where it can come from the seller or the realtor. Is typically seller. So let's say the seller gives you concessions instead of applying it towards your closing costs. They put this money aside in the buy down fund, and what that does is it's sitting there and it pays the difference between what your actual rate is and the payment rate. So your actual, I don't want you to get confused. I don't want you to think that the buy down is buying the rate down. It is not. Okay, so the rate is the rate. So I'm just going to use a fictitious example. Okay, so in this fictitious example, let's just say your rate is 6.5. Okay, if your rate was 6.5 and you were doing a 2-1 buy down, you would have a 4.5 payment only year one, and a 5.5 payment year two. Well, obviously you're supposed to be paying the 6.5 because that's your note rate. So the difference between what the 6.5 rate payment and the 4.5 payment, that's the amount that gets set aside in this account, and it's paid for your consumer out of this, out of the escrow fund, out of that kitty that's sitting out there. Okay. So to fund that is approximately, it's a little over 2.3% of the sale price. Let's just call it 2.4% roughly. Okay. So on a, $200,000 home, I have $4,800 in seller concessions. So I have a little over 2.4%. I could take this seller concessions and I could apply it towards this 2-1 buy down. Now this $4,800 is going to be there to pay the difference between what I'm going to write my mortgage payment for those first 2 years. And let's go ahead, Shawn.
No, finish. I'm gonna let you.
No, I was just gonna say, let's say I refinance. Let's say rates decline, and now I want to refinance sometime in this 2-year period while I still have this money sitting out here. You don't lose that money. It's not forfeited. It's applied as a principal reduction, principal loan amount reduction. So,
got it. So, are you essentially saying we start off with a rate, right? The first year, we're going to reduce that by 2%. The second year, we're going to reduce it by 1%. And then in the third year, you're going to go back to wherever you originally started, and that's what you're going to pay for the remainder of the term.
That's exactly correct.
So you get a discounted rate for the first 2 years.
Correct.
On a 2-1 buy.
Discounted payment.
Discounted payment.
Right.
discounted payment over the first 2 years.
Correct.
And so why would I do that versus just taking the seller contribution and permanently buy down the rate?
Great question. Okay, so here's where, because it's not for everybody. It's going to help some people, and then some people it won't. So you really kind of want to talk to your clients and make sure if this is the right fit. And somebody it might work for is, let's say I'm your applicant, and I know that in the next 2 years, something's going to change in my situation. Maybe I have a kid graduating college. Maybe I'm expecting a raise. Maybe I'm going to pay off my car next year, right? My financial situation in 1 to 2 years is going to be better because I see something in the horizon. Maybe this 2-1 works for me because right now I'm a little squeezed with money. It is a budgeting tool. I feel more comfortable, having that lower payment, through those payments until I get to that point where I can afford the high payment. But really all I'm doing is I'm offsetting what I'm bringing the cash to close by doing that. So again, it's a budgeting tool. It's not, money's not falling out of the sky, right? So it's still being applied. It's just a matter of, it's kind of like if you were saving money for a rainy day, or if you were saving up to purchase something. Sure, you could buy it. Let's say you have the money to buy it today, but you didn't want to, and you just set it aside. It's really a budgeting tool to help you, with those payments, and maybe tackle something that was a little bit more than you thought it would be. And then as far as the 1-0 buy down, how that would work is it would just be 1 year of 1% lower. So in that same example of 6.5, year 1, you would have a 5.5 payment, and then year 2 and beyond would be a 6.5 payment. And something that I was suggesting to some of my clients was, sometimes I will be talking to my clients and they'll tell me, hey, this person got ratified. The contract's going to be coming. We're getting ready to submit the file to you. And then I follow up and I find out that the borrower has now backed out because the payment is just more than they thought it would be. So like back to what we initially spoke, where, you were talking to someone, they got ratified months later and the rate jumped. Okay. If you have a situation like that, maybe you go to your buyer's agent and you see if that buyer's agent is able or willing to offer a 1% realtor credit. If the realtor kicked in 1%, they could fund, the realtor, the buyer's agent or the listing agent could fund a 1-0 buy down. And now you can go back to your borrower and say, look, I know this payment is more than what you were expecting. However, your realtor and I, we've partnered together. They're kicking in from their commissions, and now we're going to be able to get you this 5.5 payment for year 1. And then year 2, it'll go to 6.5. So we're saving you, X dollars on your payment for this first year. And maybe that helps them swallow that, maybe their situation changes in a year. Maybe they're banking on a refinance, who knows, right? But it's just something to offer to help at that crux of affordability problem that you addressed earlier.
Got you. Thanks for that. That's really creative. You just talked about refinance, so I'm going to get there for a second. But
sure.
So the way I'm looking at this, because I'm just trying to compartmentalize these things and kind of make it simple so it's not overcomplicated, right? I'm thinking about like this buy down. It's something like if someone is payment conscious and they're really worried about their payment, then the buy down is a good strategy for them. Is that right?
That is exactly correct. It's for someone that is focused on that payment. So a borrower that's very payment driven, maybe the buy down is something you look to do to help them with that payment that they're struggling with.
But if it's rate driven and it's long term, then it's probably better to use the money to buy down the interest rate so that they can have a better payment over the life of the loan. Is that
correct?
Right?
So like if they can swing, the higher payments those years 1 and 2, like let's say you compared a 2-1 buy down to maybe 0.25% lower rate total, hypothetically. Obviously year 1 and year 2, the payments would be lower, but over years 3 through 30, the scenario B with just using it to buy down the rate would be better. So again, it's all about knowing what's important to your client, what their goals are. Are they having short-term goals, long-term, how long they're planning on being in the house, all these things. But yes, absolutely. As far as the affordability and where to best utilize it too, make sure you're analyzing the rate sheets and looking at, certain coupons offer a little bit more premium than others. So just analyzing that and making sure you're giving your client the best value for their buck.
Absolutely. And so that's a good point. And so like that goes back to us as professionals to really ask all the right questions. Like, are we putting people in helping people make the very best decisions? So that comes with asking a lot of questions, right? To understand what the needs are. And so for also you out there that are listening that are clients, also think about that too as well. Like, no question is a stupid question. Like, basically we need to be asking you, what it is that you're trying to accomplish, and be prepared to be able to answer some of those questions. Put some thoughts into it. Like, is it the budgeting piece? Is it the payment part? Is it, what's your long-term goals? Like, how long are you going to be staying here? If you're saying, hey, this is a short-term thing for me, then yeah, maybe this buy down option is a really good thing for you. Another thing we talked about, speaking of refinances, Steve, a couple of days ago, actually last week when I spoke to you about this, it's actually a light bulb went off when you talked about government loans. And I didn't even think about this, like, because it's pretty safe to do on FHAs and VAs, because the problem or the potential issue that we run into when we do the buy downs is that now we have to go back and get an appraisal, right, to cover a refinance that we've done. And if home values don't increase at the clip that we needed to increase in order to roll our, the loan into the new loan and such, or the payoff, I should say, into the new loan, then you're kind of stuck with that. But when you have a government loan like an FHA or a VA that you've done a buy down on, you could just do a streamlined refinance that doesn't even require an appraisal. Is that right?
That is exactly it. That's a fantastic point. So, that's just one of the two aspects. You only need one of the two pieces of the pie on the government, right? Like, you need the rate reduction, you need the benefits of the borrower. If you have the rate reduction and the benefits of the borrower, you can do the IRRRL, you can do the FHA streamline without appraisal. But like you said, on the conventional side, even if we have that rate drop, if values aren't, holding and you don't have the value, then you could potentially run into an issue doing it that way. Got
it. For everybody, we don't have to go there, but like a streamlined appraisal doesn't require, a streamlined refinance like a VA IRRRL doesn't require an appraisal. An FHA streamline doesn't require an appraisal. So you can essentially later on, like once your terms start to change, if and when rates go down, you'll have the ability to have an opportunity to refinance that to a lower rate at that point, which would even adjust your payments to even be lower, without a lot of heartache and hassle and stress.
Absolutely. Yeah.
Cool. What else can we talk about? We talked about that because that's huge right now. Everybody's talking about that thing, like in regards to the buy downs. Even my team. So I'm not going to sit here and act like that we don't talk about it either, because it's really about what's the best solution to help more people to be able to afford to purchase homes. But let's talk about the traditional ARMs. When I price out the ARMs, because I have a lot of people that say, some of my referral sources, let's show them an ARM, or, some of the clients are asking, can we see an ARM, the adjustable rate mortgages. So what happens is the first part of your like, I'm going to use 5-1 for an example. Like, you'll see like a 5/1. The first 5 means that's the term, the amount of time that your rate is fixed for. The /1 on the other side is how often that your rate could adjust. You'll see like a 5/6, or, whatever the number is on the front or the back. If it says 6, that means it's going to adjust every 6 months. And so what typically in the past had happened is, with an ARM or adjustable rate mortgage, you would have a lower interest rate, right, on that particular product. So it's like, again, if your needs and your goals are a short-term thing, okay, cool, I'm going to be out of the house before the rate potentially adjusts anyway. I'm safe for X amount of years. Most of the time, depending upon who you ask and what research you do, every 7 to 9 years, someone is doing some sort of a transaction on their home, whether they're refinancing, they're selling, or buying a new house. And so what I'm seeing, Steve, is the 30-year fixed rate, like the fixed rates and the ARMs, they're sort of about the same, aligned. And then there's points associated with sometimes even getting an ARM rate. And so when you look at it, it's like the juice isn't worth the squeeze, like the risk isn't worth the reward to go adjustable rate versus the 30-year fix. So what are you seeing on your side with the ARM products? And what are you seeing? Are they less expensive? than a 30-year fixed, or you seen them line up about the same?
I mean, at the time of this recording today, there's not a lot of difference between an ARM and a fixed, to where, you want to weigh the risk and the reward, and the reward might not be there because you're not really seeing a huge rate benefit. But, as we've seen, Shawn, things can always change, right? Volatility, this and that. Maybe a month or 2 months or 3 months from now, the ARM market changes, and maybe there starts to become more of a discrepancy to where it is, a viable option. But today it is a little bit challenging to move to an ARM to try to fix that whole affordability issue. That doesn't seem to gain you as much as it has in the past, for sure.
Got it. I'm really excited about this conversation. As soon as I took the mic away, it was just like, all right, Shawn, let's go. You're free now. But like, what else? Like, we talked about like reverse mortgages, VA, USDA, but like, what else can we do to help more homeowners from your lens, from your perspective?
I mean, reverse mortgage, I'm glad you mentioned that. It's a great product. I mean, you've got a lot of boomers, a lot of people entering that age bracket where they're eligible for a reverse mortgage. Plaza can help you with those as well. This is a great tool for seniors to help as a part of a retirement strategy. It's not the end all be all, but it could supplement their their later ages, because with the reverse you don't have that payment that you have to make. So that can help if you're struggling with rising costs of everything else that we've got, inflation, groceries, etc. If we can help by doing a reverse and take the payment off of their plate and let them stay in the home for as long as they maintain the property and occupy the property and keep up the taxes and insurance, then maybe that's a viable option as well. Renovation loans we also have to help our clients. Those are great. Just taking the inventory, we're getting a little bit more inventory, like you said. Houses are sitting a little bit longer, which is giving our buyers a little bit more options than maybe 3-6 months ago. But then the renovation option too, to customize that home and make it the way they want it, is another nice thing. Whether it's FHA or VA or conventional or USDA, we have all the renovation products where you can go in, purchase the home, finance the renovations, and do it all in one loan. So that's another nice problem solver. And then kind of in between your traditional loan and your renovation loans, you also have an escrow holdback, which we can do. So let's say you went out, you made an offer on a home, the appraiser goes out and notices something very minor that needs to be fixed, and now the appraisal is subject to some minor repair. Well, normally this could be a roadblock, because then you're kind of at an impasse as to who's going to pay to fix it. There's a lot of back and forth. But with an escrow holdback, you can get a bid, as long as it's not health or safety related. You can get a bid, and it's not more than say $5,000 or so. You can get the bid, escrow, hold the money aside, close the loan, and then do the work on the home after the loan is closed. So another way to just keep the file moving and get the bars into the home. So.
No, thanks for that, Stephen. I actually like the construction loan quite a bit, because like a lot of these houses are being overlooked, and they're really underestimated too as well. And those overlooked and underestimated houses cost less to acquire, to purchase, right? And if you can get it for less, and then take the money through the construction loan to really build it the way that you see fit, that's a really good way to get into your dream house with less money.
Absolutely. And we even have, the ability to, this is not something that's super well known, but, Freddie Mac does allow, if you were to add an accessory dwelling unit. So if you have a property and you want to add an ADU, they'll allow for the future rental income from that ADU. So maybe that future rental income from adding this ADU helps you qualify to finance the ADU. So if it's something where, whether it's, with the last 2 years with COVID and stuff, there's been a lot of changing in dynamics where you've got some generations now, multi-generations living in the same home, people working from home, a lot more remote work. So you have a lot more need for space at home. And maybe an ADU is something you were looking to do, and you can potentially, take that on by using that, future rental income to help you with that project.
Got you. So I think you could build what up to an 800 square foot dwelling. For
I'll have to double check, but I've always.
yeah. Well, but you can build a little small,
Yeah,
like
you can
sort of tiny home,
and it doesn't have to be. There's all different ways you can do the ADUs. It could
and
be,
it depends on the zoning too, right?
you can get with your community outreach planner, and try to see which ones have already maybe been approved in that area, and then they can tell you, okay, here's some different ADUs that have already been approved, and then pick from one of those options, and have something that's already been through and that will get approved, and then basically use the specs for that to add your ADU.
This is awesome. Steve, like, I don't know what else we need to really talk about. Like, it's so exciting, and I don't really talk a ton about mortgages on here. We talk about it, but it's really, like I said earlier, an opportunity to get to know our clients and friends.
Mhm.
But in this case, I've known you for, man, I don't know, almost a decade now, I think, right?
Something like that.
Something like that. It's been a while, not quite a decade, but it's
That's
been a while. And so to I want to go on record saying I really appreciate you, man. Like, anytime that me or my team we reach out to you, you always are solutions oriented, right? It's like, how can we help you? How can we help this client? How can we help this referral source do more and do better? And I do appreciate that, because you're super knowledgeable and very creative, and you know your stuff. So I do appreciate that. Steve, Plaza Home Mortgage, couple things, like, how do you become an approved wholesale client? What do you need from us? How can we help you? And then
Sure.
lastly, with that, like, how do we connect with you?
Sure. So as far as getting signed up, you can go to our website, plazahomemortgage.com, click on wholesale, and then from there, it'll ask you to complete a broker application, and the password is my last name if you wanted if you wanted to use me to sign up. So it's pretty simple to do that. We don't use convergence or anything like that, so you can just do the online application. My contact information is my name with a period in the middle, so steve.yoler at plazahomemortgage.com. You can reach me at 703-585-3984. That's my cell. You can text me, call me, what have you. Reach out, let me know how I can help. And I love to get with you, Shawn, and my other clients, and basically connect and say, hey, what can I do to help Fortis? What can I do to help you guys, in the next year? Is, whether it's the reno, whether it's non-QM, whether it's renovation, what can I, what products or what new avenue are you trying to go into that I can help you get into to help you grow?
So is that what you need, is to pull us all together?
Yeah, we absolutely, yeah. Just let me know, put us back on the calendar, and we'll get in front of the team again.
Got it.
It's been a few
Just
months since the last time we did it, so.
yeah, just put your what is that, your cell phone up there. Now we'll pop in your email address in just a little bit. So Steve, here we go. I don't know if you thought about it or got a chance to think about it, but if you could ask one person a question, who would it be and what would you ask? So you get one person, one question. Who would it be? What would you ask?
Okay. I'd probably ask my late grandmother how she was so at peace and so just calm. Like, she was just like a rock, like unmovable, unshaken, didn't matter what was going on, whether it was her faith or whatever it was. Like, I need to know how she just, I never saw her sweat or worry about things. And she had a lot of trials and tribulations. So what was the secret sauce?
Oh, wow. That's cool. I would, when if you were to ever find that question out, the answer, please pass that along to me. I could use some of that in my life. I promise you. I promise you. But this has been fun, Steve, and a great conversation. As I tell everybody, if there's anything that I can do to help in any way, please don't hesitate to reach out. Again, it'd be such a shame for me to have relationships and people in the network like Steve and not share them with you. Everybody just continue to remain as safe and as healthy as possible. And we'll have let me see, next week's Thanksgiving, right?
Yes, sir.
So I don't think I have anybody scheduled, but I might go live on Thanksgiving next week at 2:00. Who knows? who knows? But Steve, thank you for your time. I'll ask you to just hang on for another minute or so with me, but
Sure.
after I close out. But yeah, we really appreciate your time today.
Absolutely. Thanks, Shawn.